It's been almost 12 months since our last video that touched on the credit outlook for the rest of 2024. At the time, we had a somewhat cautious view of credit markets, where valuations were stretched against underlying investor anxiety, raising financial stability concerns and a heightened possibility that financial conditions could tighten rapidly in the event of a shock. Instead, despite the unanticipated US tariff shocks and rising geopolitical tensions globally in the first half of 2025, credit markets have had a somewhat historic run against elevated market volatility. All spreads, including those for Asia dollar, US and Europe, are trading at or near multi-year or historic lows. The credit markets rally of late has come amid several positive developments, including the Genius Act for stablecoins, rate cut expectations, resilient corporate earnings, and better than expected tariff deals. As of recording date, Asia dollar investment-grade credit spreads have tightened to a historic low of 60 basis points since inception in 2009, the current spread being substantially tighter than the 10-year average of 135 basis points. At the same time, high-yield Asia dollar credit spreads have tightened to below 350 basis points, the lowest since January of 2018, when the China property sector was still prospering. Current high-yield spreads are around half of the 10-year average of 646 basis points. The story was similar outside of Asia as at the end of July, with the US investment-grade corporate credit spread at 76 basis points as of the 31st of July 2025, tighter than as at the end of 2024 of 80 basis points, and substantially below the 10-year average of 120 basis points. Similarly, the European investment-grade corporate credit spread tightened to 81 basis points versus 104 basis points as at the end of 2024, also substantially below the 10-year average of 140 basis points. Tighter spreads have worked together with still elevated interest rates to drive a conducive issuance environment in credit markets. Tighter spreads, on one hand, incentivizing issuers to come to market, while the attractive all-in yields, on the other hand, have drawn out investors looking for positive returns in anticipation of falling interest rates. While there have been sporadic periods of issuance pauses and credit market volatility, particularly surrounding tariff announcements, this has eventually provided technical support for credit markets by driving demand for credit due to a relative lack of supply. At the same time, the business and financial performance of corporates and financial institutions have proved somewhat insulated for now to higher tariffs and global trade tensions. And this has provided the fundamental support for credit markets so far in 2025. Recent reports from global rating agencies have highlighted the very limited direct impact of US tariff announcements on outstanding credit ratings as of July of 2025, with any impact concentrated in the US consumer goods sector and on issuers already exhibiting vulnerable credit profiles with tight financial headroom and/or high leverage. Global rating agencies also expect default rates to either stay flat or decline modestly in the next 12 months as US monetary policy eases and the unemployment rate remains low by historical standards. That said, their views also contain some caution for the period ahead, with credit possibly at an inflection point, as the number of downgrades exceeded upgrades slightly in the second quarter of 2025. While the continuing influences of tariffs and geopolitics make the range of possibilities around the base case for default rates unusually wide. A little more on this later. So how about the Sing dollar credit market? Well, amongst the overall positive performance of global credit markets was the resilience of the Sing dollar credit market that was more or less a beneficiary of 2025 developments. Despite the significant volatility in global markets that saw stocks at one point drop about 20%, the Sing dollar credit market's maximum drawdown was limited to just 0.4%. Even more impressive was the swift rebound that overcompensated, with a total return of plus 4.1% for the first half of 2025. Even more remarkable when compared against the US dollar credit markets, as the Sing dollar appreciated by around 7% against the US dollar in the first half this year. So what drove the Sing dollar credit markets to perform so well and stand out as an alternative safe haven amidst global volatility? The performance was underpinned by the continued lack of defaults, solid domestic demand, the rising momentum of diversification flows away from the US dollar, and the resilient credit fundamentals of the Sing dollar credit issuers that saw limited direct business or financial impact from the market volatility. The Sing dollar credit market was also attractive as it started the year providing yields above 3%. As we covered in our Sing dollar credit outlook for the second half of 2025, year-on-year returns in the Sing dollar credit market were over 7% as at the end of June, comparable to the returns seen during 2023. Conversely, total returns for Asia dollar investment grade and high yield were around 6% and 8% respectively over the same period. And this is consistent with our thoughts in the first half Sing dollar credit outlook that Sing dollar credit will remain relevant and a competitive alternative to Asia dollar credit in 2025 amidst potentially higher volatility. Again, this is given the comparable returns to the Asia dollar credit market, more resilient credit fundamentals among Sing dollar issuers, lower volatility, making it a more defensive investment, and again, the modest default rate seen in the Sing market since 2019. We continue to maintain that the Sing dollar credit market will remain supported by its defensive positioning and sustained, albeit selective, investor appetite. So what's the outlook? While credit markets continue to be looking up, judging by spreads, the question is how much longer can the good times last? Remember, global rating agencies added caution to their expectations for stable to declining default rates in 2025 and 2026. The downside risks are increasing, particularly with overall ratings performance turning negative in the second quarter of this year, marking a reversal, positive credit trends seen since the second quarter of 2024. Global central banks are also mindful that trade and tariff uncertainty may influence sentiment and adversely impact the real economy. This could lead to changes in asset values, household consumption, and business investment and lead to rising financial stability risks. The linkage between the real economy and financial markets may then create a feedback loop and higher systemic risks at a time when financial regulatory environments are diverging and global coordination is weakening that would limit the effectiveness of supervisory action in times of stress. But it's not all bad news, and we do see hope and opportunity for the rest of 2025. Major markets could see broadly stable unemployment rates and contained inflation, while GDP growth is projected to be slower in 2025 than 2024, but then expected to improve in 2026. Against credit spreads at multi-year or historical tights, we expect there to be overall credit spread normalization, with potential episodes for a sharp snapback in spreads when unexpected event risks develop. We expect spreads to be unlikely to tighten much further, but expect any widening to be contained against expectations of slower growth, that is no recession, lower rates, and still low corporate defaults. Considering this, and following a period of credit compression, the message is to stay positioned, but stay defensive.